Because we're officially live on YouTube for the Thursday edition of the Not Your Average Investor Show. Today we're doing the JWB Portfolio of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man with all the words, who I affectionately like to call GC, because he's got the genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody.
And our phenomenal community manager, helping you out in the chat, letting you find whatever you need, connecting you to anything you want. She brings us the moments that matter, and that's why we call her MTM. Her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And I want to welcome the community. If you're watching live on YouTube, if you're watching on the podcast, I feel like I haven't said this in a while, but this is a real community out here. So if you're just joining us for the first time, I would love for you to check out our Facebook group, jwbfacebookgroup.com, or in Facebook, you can just search Not Your Average Investor Show. What are they going to find there, GC?
They're going to find a lot of good stuff. First of all, they're going to find a lot of friends.
Yeah.
I think we're at 3,900 members in the group now. We're just probably one of you away from being 4,000. So maybe you could be the lucky 4,000 person in the group there. But, it's a great extension of the community that we have right here. We have new folks that come in and really are just welcome. I know Gregory starts with a T. Troncales, right? Yeah. He just came in the group just a day or two ago and sent a message and was welcome. So another great extension. Also, I know a lot of you have been interested as what's been going on in the storm here in Jacksonville. I did a storm update. I did my best Jim Cacciatore, Weather Channel update there.
That's Jim with a G.
Yes. That's
GC, Jim Cacciatore.
That's true. So obviously, a lot of really great updates there, and I'll continue to give you a good update here as we do the show about the storm, but a great opportunity for you to be even more involved in the community.
Yeah, GYM Cacciatore.
Okay, all right. That's where we're going.
That's where we're going. Join us in the Facebook group, make a friend, join all the Greggs in the Facebook group, jwbfacebookgroup.com, or search Not Your Average Investor Show in Facebook. They have a search function in there.
Yes.
Thanks, Zuck.
Yes, they do.
And now for that tradition, we're starting college football kicks off today, which is why I'm wearing this tie. But we have a little tradition of our own. It's called the roll call, baby. We got the leadoff hitter leading off today.
John Henning.
John Henning. We got Lita Song is back.
She's coming in strong. She's almost, eclipsing John there.
Calling us beautiful investors from Minnesota. Lita.
All right.
Keep flattery with me. We'll get you everywhere. We got your boy, Gregory Troncales, with a yeah. That's how he typed it, by the way. We got the ringmaster in the house. Drew Barnhill. We got the MVP.
Lee Bishop.
MVP Lee. We got the patron Santorios of the Not Your Average Investor community.
Michael Santorios.
We got the early bird in the house.
Early
bird, in typical fashion, sent us an early message saying that he will be here for the meetup. If we do it, just don't do it this 1 week that he can't do it.
Well, we're going to arrange that around the early bird. There is no meetup without.
You know what they say about the early bird?
He's there. He's pretty much there.
He gets the worm. We got our second family of the Not Your Average Investor Show, our regulars, Gary and Rosalind Riley from Murrieta, California. We regard you. Who else we got in here? We got Leo Faraganan. We got the Mountain Man.
Billy Green. From Colorado.
From the less hurricane mountains of Colorado. So when I was visiting with the Mountain Man last week in the mountains of Colorado, I was like, I'm really going to start leaning into the Mountain Man.
There's your Jim Carrey talent right there. Just effervescing coming through.
We got Maria Totino from West Palm Beach, Florida. Maria saying, pray all is safe and everyone is well in the path of Idalia. We're going to give you a little Idalia update before we get into the show today. But Maria, welcome to the show. Good to have you.
Absolutely. Welcome.
We got the esteemed Sir Peter James from the Commonwealth of Virginia is back. Sir Peter, tip of the cap to you, sir.
A little bit of time.
It's been a minute. We haven't tipped the cap. It's been a minute. We got Big Papa in the house. Love it when he calls it Big Papa.
Pops, good to see you, buddy.
Greg's dad. We got the first family of the Not Your Average Investor Show, the patriarch and matriarch, Ken and Caroline Moline. Ooh, salute you. We got the maven of real estate from the mountains of Colorado, Leslie Wilson. Good to have you in the house. We got Sergio Prieto. Go Gators. Good to have you in here, Sergio. We got our favorite name to pronounce, Aaron O'Neill, into the lights. We got Eddie Harris from Atlanta. Who else we got in here? All right, we got Eves Richard Dole is back. Eves, good to have you.
Yes,
good to have you. Past star of the show. And we got David McGinnis from Norco, California.
New name.
Right, David McGinnis. Sounds like a good Irish name.
There we go.
top of the morning to you, David. GC, give us a little update on, we just, oh, actually, wait a minute. When we're done with the roll call, it's my favorite moment of the week that I almost forgot. It's when Madison shares good news. What's the good news, Madison?
All right. Hi, everybody. So at JWB, we hit a pretty great milestone. And when we hit milestones, you hit milestones. So in the month of August, we pay our real estate investors the net rental income that they've earned for that month. This month, we have surpassed that $5 million mark. And that is after property management fees, all of that fun stuff. So we paid over 1,600 clients over $5 million in rental income just in the month of August.
What was that number again?
Over 5 million.
$5 million.
We've been teasing it that it's been coming. It's been high 4 millions distributed.
Yeah. $5 million and my team has been able to, collect as rental income, the return on the investment for all of you, and then to distribute all that money. Man, I never would have imagined that our property management company would be able to achieve that. It's the first month that we've been able to do that. It's an incredible milestone. Our team is super excited about it. You should have seen the team email that went out and just the excitement that we're able to deliver such consistent returns for so many folks out there. So thank you for your trust, and what an awesome moment.
It's just a monumental number, like $5 million. That's not a year. That is in 1 month, you collected whatever amount of money and then distributed out $5 million to how many investors?
1,688, I believe.
To 1,600. That's a pretty good take per person right there.
Yeah, that's just, the size and the scope of those who and the range of where people live, of those who trust us to deliver this income to them. And what that income goes to do is, it means a lot to me. And it also is an incredible responsibility for our team. So it's kind of like a double-edged sword there. We are so excited about it, but I think it does what it should also do, which is put the focus in the right place, that we have an incredible responsibility to all of you out there. And when we start to see the number of zeros behind those numbers, it is a great reminder for everybody on our team, the awesome challenge and responsibility that we have each and every month.
Congrats to Team JWB, and congrats to team investors out there that are getting a piece of that $5 million. Let's go. I got a couple $100 in there.
There you go.
Those are mine. Madison, you know what I call that? I call that good news. Thanks, Madison. And speaking of good news, GC, I think you got a little hurricane update. Let's talk about it.
Yeah, you know what? Thank you to all of you who were on the show on Tuesday when we talked about how, our mission whenever we have inclement weather is to, number one, protect people, and then number two, protect property. And we're always going to prepare for the worst and hope for the best. And, I'm very happy to report that we did all that, and the best is about what we got here in Jacksonville. Yeah. First of all, I want to say that our thoughts and our prayers are with those who were in the path of the storm.
Yeah, definitely.
I believe it hit as a category 3.
Yeah.
If I don't remember, if I don't forget. So on the west coast of the state, the Big Bend area, the state of Florida, is dealing with a lot there. So our thoughts and our prayers and our concerns go there. The storm is, of course, passed by now. It's a fast moving storm, went up through Georgia and left Jacksonville largely untouched. If you were in the Facebook group, you saw the video that I did, and, we had about 30-mile-per-hour winds or so for the majority of the day.
Yeah. It was a windy day here.
It was a windy day.
Yeah.
We had a lot of palm fronds that were down.
Yeah.
And so the team is safe, our residents are safe, our network is safe. And so that's mission number one. And, largely properties are unscathed as well. I shared with you that I'd get some real stats beyond just kind of, the feel of how it went. So I wanted to share some of these real stats with you. So, what it's like in terms of call volume and maintenance work orders resulting from the storm. It's just incredible. The response is the incredible part. If you remember from our call on Tuesday, my whole team is mobilized, making sure that we're there for our residents in times of concern. Well, guess what, guys? We only had 37 calls come in related to the storm all day yesterday, which I asked what our average call volume is on a typical day.
Mhm.
It's about 60 calls a day on the maintenance line.
Okay.
So a very slow day on the phones yesterday, which is welcome for all of us, of course. Number one, making sure people are safe. And then not a lot of property issues. Actually, we only had 16 work orders that came in yesterday that were storm-related work orders.
Okay.
So
16.
out of over 5,400 properties that we manage.
Yeah.
So, really wonderful to share this news, but there's even better news. I wanted you to know just the commitment to being there for our residents. When you asked me on Tuesday, what's the most important thing in terms of a storm and preparation, it was taking care of the easy things that you can take care of. And then number two, being there for your residents. Happy to report that my team answered 100% of the phone calls that came in for our residents that had any maintenance related issues to the storm. And we actually tracked the wait time. The average wait time for those phone calls, 5 seconds.
Oh, wow. That's awesome.
5 seconds.
Yeah.
If you want to see what a vertically integrated premier property management service team looks like, that's what it looks like when your residents and your team need you the most.
That is excellent, man. I can only imagine if you really were going through something in a storm to have to be put on hold or something like that. That is, that resident experience that you all are so proud of. To me, when I hear that as a owner of the property, I'm thinking happy residents are going to stay there longer. They're going to think twice before they go, move at the end of the lease. They're going to accept whatever increase is going to happen. They're appreciative of a good situation, because I've definitely lived under like not great landlords.
Yeah.
And that makes a big difference.
I call it a moment of truth.
Yeah.
Right. When you're doing business with somebody, you have certain moments that just stick in your head. And this is one of those moments that will stick in the minds of our residents to know the level of service in challenging times. And it comes from preparation, strategy, commitment from the team. And this started years and years ago for emergency response. How are we going to make sure that our team is there to serve? So a big shout out to the JWB team. I hope you all feel very, very at ease when it comes to the storm, not just because the storm largely did not hit Jacksonville, but also because that your residents were taken care of, even for the ones that were slightly affected.
Awesome, man. I'm pretty happy that it didn't really hit us, right? Like it kind of, for whatever reason, Jacksonville hasn't been hit by a direct hit in how long? In 100 years or something like that?
I don't really want to talk about it.
Yeah.
I'll tell you, just because you should know the fact that we've never actually had a direct hit from a major hurricane being a category 3 or above. And the last direct hit that we had from any hurricane was back in 1964, which was Hurricane Dora. So, knock on wood.
Yeah. All right.
There you go.
Good stuff. Good stuff. All right, GC, that's a great update. Happy to hear that. I'll report that I had my light flickered for a second,
Oh no.
but it was during a podcast. I was being interviewed on a podcast and my modem went down, my router went down because it just cut off. So
we were playing with fire there. To do the podcast.
It's funny because I texted the person. I was like, oh, I forgot that we actually have a hurricane. So, he's pretty empathetic and we were able to finish it. It wasn't a live show like this one is. So thank goodness for that.
Gotcha.
And okay, so let's move on to the we got some breaking news, GC. Is that what's going on?
We do have some additional good news right alongside the good news that Madison shared. We updated some of the numbers here. Every once in a while, I'll go back and I'll update some of the stats. Well, as you all have probably been paying attention to or have read the titles and descriptions of the shows, you'll see that we talk about how JWB manages over $800 million of real estate assets. Well, for the last, little while, that's been a bold-faced lie. I'll just tell you.
Oh, really?
I didn't update the numbers in the last, 6 months.
I mean, you've been telling me that number since I came on board here about 3 years ago.
Just a bold-faced lie for as long as that is, as I've been telling you that.
So what is it, GC, if it's not 800 million? Is it less?
The real number is actually 1.3 billion. 1.3 billion.
Okay.
That's 1.2 billion roughly in turnkey rental properties and property management that we manage, and a little bit under 100 million when it comes to private lending investments that we manage. Total that up, $1.3 million is what our team is entrusted with all day, every day for the last 17 years to deliver for you out there. It's an incredible responsibility, something I want to say thank you to all of you. Many of you are clients out there and you contribute to that 1.3 billion that we get to manage for you. And I just want to say thank you. And it's an incredible opportunity and an honor to serve your funds.
That's a monumental number, man. I wonder how that compares to, because I see JWB less as a real estate company and more as a portfolio manager of retirement accounts, right? So I wonder how that compares to a financial advising team that has assets under management. How many in the country have 1.3 billion that handle that amount of money, that amount of capital, that amount of clients? I think it's a pretty interesting thing to consider.
Not a lot in single family, turnkey rental properties.
Yeah.
Not a lot in our little niche of this investment world that we love so dearly. You'll certainly see that and more when you get into commercial and other
Yeah.
things of that nature. And then when you talk about the big brokerages, right, who manage more traditional assets, certainly more than $1 billion is pretty common. But you know what they do with their more than $1 billion that they manage?
What do they do, Jason?
They charge you. They charge you for it. They
Yeah.
charge things called asset management fees. JWB doesn't charge any of those. So that money that we manage for you, we manage them, and we treat it like it's our own, and you get to keep all of that. You know, when you sell your house later on, way down the line, you realize the appreciation that you earn. Guess what? We don't take a piece of that. You get to keep it all. So I think it's the best type of asset management for our clients. We get to, of course, perform at a high level and with a lot of responsibility out there, but you get to keep your share and you don't have to pay it in fees.
Pretty impressive, man. Another slew of impressive accomplishments, numbers. I have to assume that the appreciation of the real estate that's happened, right? Like, it's one thing is you have found more investors and you've sold more properties and you've acquired more things. It's also the things that you've invested in have greatly appreciated, right? So that number is going to continue to go up, period, right? Like whether you get new investors or not.
100%. It's the beauty of being in a growth market.
Yeah, I love that, man. Love that. All right, GC, well, let's talk a little bit about how that 1.3 billion is, what it's made up of. Let's go into one of these portfolio scenarios. I'm just going to preface this for our community. We are trying different things, right? Like, we went from the property of the week to now we're really showcasing this idea of investment making decisions and teaching you what are the different decisions that you are making and how that plays out over time. Because it's one thing to talk about cash flow today versus cash flow tomorrow. It's another thing to talk about how this is going to actually affect you, right? So benefits over features kinds of things is what we're moving to make this clearer, help you make better decisions. But like all investment advice that you get on a radio show or a television show or a podcast or an internet talk show like we have to give you a little bit of due diligence. GC, you want to tell them about this little slide here?
Yeah, and you guys should probably be expecting this, right? We're going to talk about financials here. We're going to talk about estimated returns on investment. And anytime that you are listening to that and educating yourself with that, that's the first step. You also should do your own due diligence. So, friendly reminder to all of you, before you make an investment decision, listen here, come here, learn, be a part of this community, and also do your own due diligence. And that way you can walk into this investment confident and know that you made the right decision. And without further ado, let's talk about what we're going to talk about today.
What are we talking about today? Give me the scenario.
Well, so here's the thing. Whenever I'm thinking about the real estate portfolio of the week that we want to jump into now, I'm thinking about the questions that I'm hearing or that my team is hearing from current clients. And we hear amazing questions, but a lot of them are really similar. And so I start to kind of take all of these questions or the common themes and put them into this portfolio of the week. And one of the questions that we get often is, talk to me about cash flow. And the response that we give to that question, who is a client coming to us, is, well, what's more important to you? More positive cash flow or more long-term growth? And it sets the stage for this wonderful dynamic, back and forth for us to build the perfect portfolio for that client at that moment in their life. And so I thought we would kind of go through that whole kind of, we'll put together kind of bits and pieces of that plan together today and build this ideal portfolio, which will be kind of catered to you. If you are somebody who wants more positive cash flow today, you'll see how that portfolio would look. If you're somebody who says, hey, listen, positive cash flow is not going to change my life today. I don't exactly need more positive cash flow. I want more long-term growth. Well, you're going to see how we will build that strategy for you.
Love it, GC. And I know now we're dealing with an assumption of someone coming with $300,000 in capital. Right. So I know that this is based on a true story. So talk to me about where this capital would come from. Is this someone that where would somebody come up with $300K in capital? Yeah.
So a lot of folks don't have $300K sitting in their bank account. A lot of folks have $300K sitting in either their retirement accounts or in their brokerage accounts. When clients come on board now, we ask to do a financial review with the client. So they'll sit down and they'll tell us where their money is currently. And when we sit down, an overwhelming majority of clients have their money in two places. One is equity in their primary home, because as Americans now, we're sitting on over $10 trillion in equity, and the average American has over $200,000 in home equity. So that's really common. And then the other place is stocks and bonds. And that could be broken up either in their retirement accounts or outside of their retirement accounts. So when we're talking about helping people reallocate their money, what we mean is folks are just not comfortable with the amount of dependence they have on the stock market. And they want to take that money and they want to put it into another asset class. And it might not be all of it, but they don't want to have two legs to the stool. They want to have a three-legged stool. And so instead of just equity in the primary home and money in the stock market, they also want to have money in an asset like real estate. And that's largely where we see large sums of money coming over.
Yeah, and I think that's key because I think when we think about a real estate investor, we're thinking of people that have this like capital that's on the sidelines waiting for like a real estate purchase. It's just like in a bank account, you're using this for real estate. But the average, the not so average investor, right, which is the typical JWB client, that's not really what you're thinking. You're just thinking, hey, this is my net worth. I have it in all these different places. And what I want to do is probably diversify, probably find one part where it's more risk averse, right? Like less risk, probably find something that is going to make the money that I already have work a little bit harder than in the places that I already have them. So that they're coming this way. So it might be a mix of, hey, I just got a 70K bonus, but I can also pull some equity out of my house. And by the way, I also have this other portfolio that's being managed by a stockbroker that I can also take another 100K out. And now we're talking about a 300K amount of capital that you can now do this stuff that we're about to talk about, right?
Exactly.
Cool. So let's talk about it, GC. So this is the first scenario of somebody with 300K who is asking for more positive cash flow. They want the cash flow today. Talk to me through it.
So when somebody says they want more positive cash flow today, this is how I would build their portfolio. We might put 50% down on the properties for their portfolio. Now, when we put 50% down instead of maybe 20% or 25% down, Pablo, what do we do to that monthly mortgage payment?
The monthly mortgage payment is going to be less.
It's going to be less. And what that does is creates more of an opportunity for more positive cash flow. So if somebody says more positive cash flow is what I want, my lifestyle needs that right now, we start to think higher percentage down. Okay. When we do that, we are going to limit the number of properties that we put in their portfolio. So if we put 50% down because a client wants more positive cash flow for this $300,000, that might be 2, maybe 3 properties in their portfolio. And by doing that, year one cash flow is really strong. This is year one monthly cash flow, I should point out. $530 a month is what a portfolio that has 50% down would create. And we can start going down the line there a little bit more. And we start to look at portfolio value. By putting 50% down on this portfolio after a 20-year hold, the expectation for their portfolio, including all 5 profit centers, would be over $1.4 million, which would equate to a 9.3% return on investment year over year over year for those 20 years.
Got it. So this is the baseline assumption that we're going to start with. I have 300 grand. I want cash flow coming in, right? $530 in monthly cash flow. That might pay my car lease or my car payment or something like that, right? So that's significant cash flow that I can be using if I want to be using it. So I take my 300 grand. I'm going to get 2 to 3 properties at 50%, right? So like I'm assuming that these are $250 to $280, $300,000 properties. I'm buying 2 or 3. I'm putting 50% down. I'm now cash flowing at $530 a month between all 2 or 3 of them. In 20 years, that 300K is worth $1.4 million, 1.4 and change. And that represents an IRR of 9.3. So this is the person that is like, give me the cash flow today. I need to be spending some of this right now.
Yeah. And let's kind of put it out to the audience. How many of you, when you started to invest, maybe even before you came to this show, when you thought about investing in real estate, your first question was, tell me about positive cash flow. How much positive cash flow? How much positive cash flow? Just, wave your hand or say something in the chat there if that's been you. That's a really common thing that we'll hear. And my response always is like, guys, 2 things. Number 1, positive cash flow is the easiest thing to create in real estate, right? It's the easiest thing. So some people think that it's really hard to create positive cash flow. it's really easy to create positive cash flow. And thank you guys for thumbs up and waves and some,
Yep.
yeah, that was
Yep.
me.
Yep.
Lead a song. There we go.
Bill, Ron, Gary,
Really,
Rita.
really common.
Yeah.
Well, positive cash flow is the easiest thing to create. You're just manipulating the down payment percentage to making sure that you have positive cash flow. That's easy. So just because interest rates have gone up more in the last year, and home values have gone up more in the last year and the last 2 years, that doesn't preclude us from creating positive cash flow. What it does is it means that you got to put a little bit more down as a down payment to get there. But at the end of the day, if you want positive cash flow, you came to the right place if you're investing in single family rental properties.
True. Got it. Okay. So that is, I see many folks wanted positive cash flow. I see a couple folks here that just wanted to not have negative cash flow, right? So a lot of what we talk about, and those folks I would assume were folks that were opting for not cash flow, but growth, right? So like, let's talk about what it would look like to opt for growth if you have $300K to invest in.
We're going to do growth, and we're going to do max growth here.
Okay. So this is max growth.
Somebody comes to us and they say, I want this portfolio to grow as much as possible over the next 20 years. This is what we're going to do for them. We're going to go in a little bit of an opposite direction for down payment.
Okay. Talk to me through this.
All right. And so for a more long-term growth strategy, we're going to put 20% down. 20% down is the minimum that you'll be able to put down for an investment property. Now, by putting 20% down, our money is going to go farther in terms of the number of assets we get in the portfolio. So we'll actually be able to turn that same $300,000 into maybe 5 or 6 properties in the portfoldio. But what's that going to do to the monthly cash flow in year one, Pablo?
It's going to make it pretty negative.
Ooh, negative $1,300 a month for negative cash flow.
Yeah.
For a portfolio that's focused on max long-term growth, 20%.
Yeah.
But what's that going to do to the portfolio value in 20 years, Pablo?
I mean, it is an extra almost $1 million that you make in 20 years.
Yeah. So where if you put 50% down and you had all that positive cash flow in year one, you would have earned $1.4 million at the end of 20 years. Well, that same $300,000 can be turned into $2.3 million if you put 20% down and you wanted to eat the negative cash flow in year one and for subsequent years after that. Ultimately, at the end of the day, it's a better return on investment.
Yep.
Even though you have negative cash flows right off the bat because of all of the growth that you receive coupled with your use of leverage. And so your return on investment year over year would actually be 9.7% if this was the right portfolio for you for putting 20% down.
Talk me through the leverage component, GC, because we haven't discussed that in a while.
Yeah. So, I mean, the way that rental properties and real estate in general beats the returns of the stock market is because it couples two things. It's an asset that consistently grows each year. Home price appreciation happens almost every single year. And you couple that with the fact that you only put a percentage of your own money into the deal. So when we say you put 20% down, that means you put 20% of your own money into the deal and the bank brings 80%. So when you're calculating your return on investment, it's not a calculation on return on price. It's a return on your investment, which is only 20%. And so when you start to couple assets that appreciate with the fact that you only put a small percentage down, your returns on investment go way high. And that's why this asset class consistently beats the stock market when it comes to overall return on investment.
Yeah, the way I look at it is, if you're getting these 5 properties at 20% down, right? Like you are, let's say it's 300K, so 5 oh man, I'm gonna get messed up on the math, right? But like, let's say you're doing $100,000 for a property, right? To make the number simple. Sure. If you're putting 50% down, you're putting $50,000 for a $100,000 property. When it appreciates, let's say, 4.7%, like it does, and $100,000 is going to appreciate $4,700, right? But you're appreciating off of the entire $100,000, not just the 50 you put down. Same as if you buy a property for $100,000 and you only put 20% down, you're appreciating on the capital that you put down, right? But you're also appreciating on the extra 80 Gs. You're getting that extra appreciation, which is the magic of leverage.
Right. Our goals as investors should be just accumulating an army of income producing assets, right? It may not produce income year one. This is going to produce income at some point, but your goal should be able to produce an army of income producing assets stack your portfolio as much as you can, withstanding the cash flow hit, right? Because at the end of the day, the appreciation that you get on 5 or 6 assets is more than the appreciation that you would get on 2 or 3 assets in terms of like real dollar value. Those 5 or 6 assets each appreciate each year, whereas you only have 2 or 3 assets that appreciate each year. So if you can do that with leverage, you're going to earn a higher return on investment. That doesn't mean that this strategy is right for everybody. You guys have heard me on this show talk for years and years and years now about how I believe in positive cash flow and assets that pay for themselves every single month. So I would only put a client in this strategy if we have a real open conversation about what other passive income sources are going to offset this negative $1,300 cash flow situation.
Yeah.
And some of our clients are real high income earners and they can afford to, throw $1,300 a month into an asset like this. But that's not for everybody. This would be, I would say, the minority of investors, because this asset is just so beautiful that it can pay for itself every single month and you don't have to go negative to do it. But I wanted to show this as an example of something that could work for those out there.
The other number that sticks out to me here, GC, is the fact that, this 20-year value is almost $1 million in difference, and yet the IRR's difference is 9.3 versus 9.4. Can you explain that?
Yeah, I'm really glad you brought that up too. This is the reason that we have to make sound investment decisions based on internal rate of return, right? And internal rate of return is the way that we calculate your return on investment. And even though you see a huge difference there between 1.4 million and 2.3 million in terms of total portfolio value, you only see 9.3% to 9.7% in terms of the return on investment. Because what you have to take into account is the timing and the size of the cash flows that come back to you, right? And if we think about time value of money, right? The fact that if you could have $100 today, it's worth more than if you receive $100 a year from now. And think about what happens in real estate. Home values go up over time, and you don't actually realize the home price appreciation until a point where you either liquidate or you refinance, which happens many years down the road. So even though you're getting a bigger pile of money when you do a long-term growth strategy of only 20% down, that big pile of money takes a long time to come back to you. And if it takes a longer time to come back to you, it actually depresses what the return on investment is. Whereas in the more positive cash flow situation, that's $530 is their month one of ownership. So you're receiving the money that day or that month. It's much quicker and it's worth more than if you received it 5 years down the line, 10 years down the line. So that's how you can earn a lot more money, but your return on investment is not wildly different.
Got it.
So,
and this is why we talk about IRR versus ROI, right?
Yeah,
because
if you and this is why we went so hard in teaching about IRR, and this is why we talk a lot about it in the class that we have, the Not Your Average Investor Guide to Investing in Rental Properties. The reason is because this is how you make sound investment decisions. When you're investing in things like rental properties, the cash flows coming in can be somewhat complex, right? You might get more this year. You might get more next year. In 5, 10, 20 years, you're going to see a huge pile of money come your way in terms of home price appreciation. But it takes a long time to happen. You need a tool to be able to analyze all of that and give basically an average of the return on investment over those number of years so that you can compare that to a more simple investment, like what are you earning in your checking account or something like that. So IRR is that apples to apples comparison that lets us make sound decisions when you have variable cash flows and variable timing.
Got it. Well said. And GC, am I out of line in thinking that? So these are all complex numbers. We've talked about a couple of concepts here. Number one is where you pull your capital from, not necessarily needing to just be a pile of cash. There's different places that not your average investors pull their capital from in order to build these portfolios. That is something that JWB helps people figure out when they go to chatwithjwb.com and schedule a call. And also, this is 2 scenarios. We're going to go into a third after we answer a couple of questions, but tweaking these numbers, 50, 20%, 300K, 150K, 20 years, 10 years, that is also a typical conversation that you have if you schedule a call with JWB at chatwithjwb.com. This is what y'all eat for lunch.
This is what we love to do.
Yeah.
Like, this is financial engineering at its best. This is what you don't get when you go buy a rental property the normal way.
Yeah.
You don't get to have conversations like this with a typical real estate agent. We like to think of ourselves as being this advisor for you in the real estate world. We just have an asset, which is real estate, right? But the same concepts of how to manage money effectively should be there regardless of which asset you invest in. This is what you need to look at when you're thinking about, how do I make a big part of my financial future real estate? It needs to be this type of concept. And so when we think about you, we think about what are your goals? We then translate into, how do we build a portfolio? How much should we put down? How does that affect your cash flows in year one? How does that affect your long-term growth? That's our calling card.
Got it. So that being said, this is an open invitation to, if you have like specific questions on stuff like this, go to chatwithjwb.com, schedule a call. That is what that first call is all about. It's just how to tweak these numbers in a way that make more sense to you. And that being said, we also have this like vision of turning this show into, you got a scenario, bring it to us, right? So like, if you have a specific scenario and you're in the Facebook group, or you want to shoot us an email, or you want to just tell Madison that you want to set up a call later with us, bring it to us and we'll do a breakdown just like this on one of these shows. We want to turn into like the Dave Ramsey of not stupid people that can't handle debt.
Wow. I'm gonna call it Dave and tell him that you said that, by the way. Yes, I just think this is a really great way to bring people into this asset class,
Yeah.
remove some of the kind of the mystery, remove some of the fear. Is just, let's start wheeling and dealing. Let's start bringing the challenges. And Greg, what would you do here? How would you build this portfolio? And we have the tools and the ability to really help you on the fly. And so, yeah, our great vision is that we can turn kind of this real estate portfolio of the week into more of an interactive, audience-driven thing. So there's the invitation out there. Hopefully you guys take us up on it and we can kind of include more and more in coming weeks.
Yeah, got it. Love that. So let's answer some questions. First of all, I want to say I have a tremendous amount of respect for Dave Ramsey.
Yeah.
Just a very simplified message of just villainizing debt. I think you can be much smarter with your money if you learn how to use debt instead of make people afraid of it.
Dave's a real estate guy, by the way. Dave's a real estate guy. So
he's a real estate guy, not a financial engineer.
I'm gonna call up Dave right now and I'm gonna tell him that you said that.
You do what you do, buddy. You do whatever you got to do. All right. So we do have so Gregory Turncalis is actually asking, how does this look for 10 years? Are you able to just kind of
100%
spitball that right now?
I mean, I can't spitball. There's so many calculations that go into this right off the bat that I can't give you just a real number there, but that's a great invitation, Gregory, to give us a call. I mean, we have the tools. It's literally a point and a click, and then the whole portfolio can change to a 10-year outlook or a 30-year outlook. So reach out to us, go to chatwithjwb.com, and that's the whole phone call we'll get to have with you.
Love it. And then another one that seems like we might have to do on chatwithjwb.com or send us the full scenarios. Javier Yepes is asking, what's your cash on cash return since you're putting down 50% in this scenario? Do you know how to calculate that like off the hand?
Yeah, it's hard to give it just a general answer right there based on that. We would have to look at the numbers, but easy here. If your break even cash flow, your cash on cash return is 0.
Mm-hmm.
So when I hear cash on cash return, that's usually focused. That's somebody who's normally more focused on more positive cash flow. And one of the things we talk a lot about how if you only focus on cash return and you only focus on cash flow, you're missing the bigger picture when it comes to the successful nature of this investment, which is built on 5 profit centers. So the cash on cash return answer is an easy one to accommodate whatever you'd like. If you want your cash on cash return to be higher, it can be as high as 4% or something along those lines. But what you're going to be doing there is you're going to be putting more down, right? If you put more and more down, then you limit long-term growth. So I know I didn't give you a specific there. If you would like a specific, reach out to us. We can build a portfolio based on that, but it'll be somewhere, call it between 0% and 4% for a typical portfolio for JWB.
And Greg, as you know, my education has been a lot through this show. So I've never really thought about cash on cash return, but as I talk to more and more other investors, they mention that a lot. When people say cash on cash return, they're talking about cash on cash return day one, right? Like they're just talking about essentially like how much is this thing gonna yield for me that I can live off of right now? Does cash on cash return take into account the fact that this is a cash growth portfolio and that cash continues to grow for the life of this investment?
Cash on cash return is very myopic for a lot of reasons. So the reason that you just pointed out there, it doesn't talk about the fact that this net rental income, which is what drives cash on cash return, that grows over the years because rents grow over the years and your main expense actually stays the same. So your cash flow grows. So your cash on cash return gets better over the years. So no, that's typically not factored in when people just rattle off a cash on cash return.
That's good for me to know. All right. Eddie Harris from Hotlanta says, Greg, is that initial cash flow factoring in today's insurance costs, et cetera? Seems high, even with the 50% down. And thanks and great job.
Absolutely does. Factors in every part of the investment, taxes, insurance, property management fees, all that good stuff. So yeah, it's all in there.
All right, cool. And then Gerard Wenling
Oh,
says,
let me add one thing.
Yeah.
Actually, so for year one cash flow, it does not include any maintenance and vacancy. Why do you think that is?
because there tends to be very little maintenance and vacancy
Yeah.
year one.
Year one, it
Yeah,
does. So, but it includes maintenance and vacancy all throughout the investment. So in things like the 9.3% return on investment and in the total portfolio value, everything is included, maintenance, vacancy, you name it, it's in there.
Got it. All right. So Gerard Wenling has another question. Hey, gentlemen, is the cash flow plus or minus considered? Is the cash flow plus or minus considered in the calculation of the 20-year value?
Absolutely, Gerard. It is, it's all in there in that 20-year value. The 20-year value is composed of all 5 profit centers. So your net rental income is your first profit center. Second one is your tax savings. Your third is your principal pay down. Your fourth is home price appreciation. And there's the fifth one, which actually is not calculated into the total portfolio value, but it's just an added bonus. That is your inflation hedging and inflation profit.
Got it. All right, GC. So now we've gone through these 2 scenarios. Let's do the Goldilocks approach, right? One is too big, one is too small. Let's look at one that's just right. Yeah.
So let's say you're more like, I would say, what our typical investor, our typical, not your average investment. There you go. You're probably coming to me and you're saying, listen, I just want it to be break-even cash flow. And then I want to focus on growth after that. And that's been our calling card since we started to build this business. That's been my calling card. When I first started to invest and I didn't have any money, you better believe I was making sure it was at least positive cash flow or at least break-even cash flow. Even if I could have achieved higher growth, I was making sure that I take care of rule number 1, which is making sure it's an asset that pays for itself. And so that's really a sound investment strategy. So this third one is more typical and more how most of our investors would invest. So putting 35% down right in the middle there with the 3 little bears there. Your portfolio will have between 3 to 4 properties in it. And in your year 1 monthly cash flow, you're basically break even. Right? $36 a month, right? The things that I have shared with you for years and years and years now, how, cash flow is not going to change your life, even if it's $100 or $200. We're building this thing to be break even, and we put the right percentage down to make sure that we engineer it that way. And then what you find for your year 20 portfolio value is you're right in the middle of the previous 2 approaches as well. So after 20 years, based on these numbers, which is historically how Jacksonville has performed and how JWB has performed, we would turn that $300,000 into about $1.7 million for this client. And the return on investment would also be 9.7%.
Pretty good, man. I mean, that seems like a nice little Goldilocks number right there, right?
Feels right, right?
It just feels right. It just feels right. I like seeing this in front of us, GC. I know that you have iterated a couple of different times of like how to illustrate this topic. I think this is a nice breakthrough. This idea of, your pile of money. I remember in financial accounting in college, the first thing that they said is like, when you ask an accountant, what is a dollar worth? They say, depends. Right?
Yeah.
I know you probably had the same financial accounting guy as I did, right? I forgot that these names. But if you are sitting on, you just made a $50,000 bonus, you have a certain amount of money in an account of the money that you've been saving, and you have it with a financial advisor, and you also have a certain amount of equity in your house, right? Like that adds up to $300,000. It can be worth in 20 years, $1.4 million. It could be worth $2.3 million. It could be worth $1.7 million, depending on how you do it. So it's like this idea of going to an expert, right? Like going to a resource that understands financial engineering, whether you have studied this for a long time, you have a buddy that's a genius in this, or you just want to go to chatwithjwb.com and ask a couple of questions of how this can end up looking based on your lifestyle. If you are somebody that really needs income off of that money right now, say you're later in life, or, you know, like this is where you're going to be and you want to start living off of it some, you go this 50% route. If you are a high income earner, right? Like you are a doctor that makes 500 grand a year and your monthly living expenses are maybe $20,000 less than you make a month, kind of thing, then you can go through this like fast growth route that you're trying to get at so that you can get out of being a doctor sooner and get the growth faster. If you're like right in that middle where you don't want to, have to come out of pocket every single month and you don't want to keep putting in there, you just want to continue your lifestyle the way that it is, then you have this Goldilocks number of 35%. And based on that, then you have these different levers that you can grow more or grow less. But at the end of the day, you're still in this like 9 to 10% range of IRR, which is generally better than you're going to get in any kind of like 60-40 portfolio that you're being
Vanguard
offered
says
at.
you're going to earn 7%
Yeah.
over the next market cycle. And that's another thing that we get to share with clients when we're going through the onboarding process is if we did none of this and we just kept this $300,000 in your stock market brokerage accounts, how would that look over the next 20 years? And so it's really fun. You can see the differences, and depending on how much is being invested and how long we're running this thing out, many times it's hundreds of thousands of dollars different when you put it into the portfolio like we build for our clients here at JWB.
That's awesome. That's awesome. And Javier's got another great question. Javier Yep is saying, how would you scale to more than 2 to 4 properties if you allocate all your $300K investment? Would you take out some of the equity from your 2 to 4 props? What does this do to their cash flow?
Great question. So now we're talking about kind of like phase 2 of the plan. What we just kind of built out is the initial investment with that $300,000. Where can we go from this? Actually, let's kind of talk about you.
Yeah, I was just thinking this is me.
Yeah, why don't you share your idea?
My idea is, so I had a certain amount of money. I did the same thing, right? I had some money in retirement. I had my first property I bought off of money that I had, right? Like it was just cash sitting in my bank account. My second property, I took money out of the stock market and bought a property. And my third property, I took money out of a retirement account and bought a property, right? So I was tapped out at that point. When I purchased those 3, I'm down to like the cash flow that I want monthly and the reserves that I really want to have in cash. And what I think is going to happen for me, Javier, is that in probably this was like 2 years ago, right? So probably in like 2 to 4 more years, I think that there's going to be enough home price appreciation, plus the amount of cash flow that I'm getting off of these houses that I'm putting away, plus interest rates are likely going to be lower than they are right now. And I'm going to be able to refinance the properties that I have right now, which are 3, and maybe pick up 1, 2, or 3 more properties, which is what we've seen people like Hervé Francois make famous on the show, and a whole bunch of other people that this stuff, you put it in, and in time, it makes other properties, right? Like it leads to that infinite returns time. Does that make sense?
That is the most fun strategy, right?
Yeah.
And a lot of our clients have experienced what you're talking about there. I think of Jen Filzen and how we grew her portfolio. I think of, I think of Dean Curry. I think of others. So, that strategy where you're able to take these assets, you invested with the right team, you invested in the right market, and you give it some time and the equity grows. And then real estate is beautiful because then you can just tap into that equity really easily. You just refinance, right? It doesn't even cost that much. Right. And you're playing with the house's money too, because you're taking it out of the money you earned from the equity. So that strategy there where you take your assets, you let them grow. Now it might not be 2 years, right? Pablo's a hype guy, right? I'm the kind of the Debbie Downer every once in a while here. It may not be 2 years. There's other things to consider, right? We have to achieve a certain amount of equity for it to make sense for you to pull it out. And you might not have as much equity as you need in 2 years. Maybe it's 5 years, maybe it's longer than that. But at some point, you've got a team here where we will say to you, hey, guess what? Your portfolio probably has another $100,000 of equity that you have built up in your properties. what if we put a plan together to help you refinance those properties, pull out that $100,000 and turn that into another 2 properties, right? Why don't we talk about that? And so that's how one of the ways that we help clients go from an initial 2 to 3 properties to 5 to 6 to 10, 15, 20, like, Zach Correa, who's in the chat all the time, right? These are strategies that our clients are using, and it's a part of it's how we think, it's how we're built to identify those strategies and then make it easy for you to continue to scale up.
Love it, man. Love it. Gerard Wendling has another good question here. How do you determine when a major refresh/rehab should be done to maintain the rent potential of a property? And is that included in the 20-year value, i.e. updating a kitchen?
Okay, great question. So yes, every cost is included in the 20-year value here. So if there were routine maintenance costs, like for example, let's say that you paid to mow the lawn while the home was not occupied, we were getting it ready for rent, that cost is included here. If there was a property turn, and in the property turn, we had to do some major updates to the kitchen, that would be included here. If we had to put a new roof on, every one of these expenses is included there, because every one of those expenses is included in your expected maintenance cost on every asset that you purchase with us. So the second part of the question is how would we make the decision of when to do that? When we talk about updates, I think people get this idea of like maybe how we would think about updating our own house based on like our emotional opinion of what we want.
Yeah.
We're not going to make decisions based on updating things in that nature. It's not going to be emotional. We're going to be able to build this home and renovate this home and maybe update this home to the standards of what we see other homes in the neighborhood renting. We're going to do a very quality job on your renovation, and we're going to make sure that it's built to withstand a resident and a family living in that home for on average 4.5 years. So how would we make that decision? It's the same way we'd make any decision when it comes to a renovation or a turn. Nothing different. It's not emotional. It's about the materials that are working in all of our other homes. And, when would we make that decision? Usually when a resident leaves, we look at the property turn, and that's when we would assess, hey, is it worth it for us to recommend to you? Is it worth it for you to spend a little bit more money to update the cabinets? If it is, we're going to make that recommendation. If it's not, and the home is going to rent great based on what other homes in the area are renting for, and we don't have to ask you to make that cost or pay, make that investment, then we're going to be happy about not having the most updated kitchen out there and just having a really great performing investment for you.
Yeah, I mean, 2 things come to mind. One is what we learned or at least what I learned in putting together the class with you, which is that you renovate these homes or build these homes already to the standard of best ROI for an investor, meaning durable materials that can take a beating, easy to maintain materials so that you don't have to replace them, and easily replaceable materials so that it's not, you are maximizing the idea of changing out one part of something without having to change out an entire piece, right? So like that's one. And then the other thing that I think about is this is workforce housing, right? Like I would assume that there's a standard of all of us here as investors. We think, wow, we got to have a bathroom of this standard and a kitchen of that standard. For workforce housing, people are living there for functionality, right? Like they're trying to like have the best experience that they can, but they're not going to demand the latest style that they see in a magazine when they're moving in, right? Like, do you get a lot of tenants that show up and say, well, I'm not moving in until you renovate this bathroom?
No, we don't. I think that this is, because we put $40,000 on average of renovations into the home, it's a little bit kind of in between what you were suggesting there, right? Like people in our neighborhoods go into our homes and they're like, wow, this is really, really nice. I mean, we put $40,000 on average into an average square foot home of maybe 1,400 square feet.
Yeah.
I mean, when you do that, you are making things pop because they are just renovated. Now, at the same time, the materials that we use in the home, they are not going to knock your socks off. It's not going to be the nicest amenities that you can ever think of. They're just going to be, most of the time, brand new, right? Or $40,000 into a home, or maybe there's a brand new construction home. So there still is a feel when residents come into our homes like, this is the best living situation that I have found of any home that I search for in my neighborhood. But to your point as well, nobody's coming to us and saying, listen, I really like this home. I really like this neighborhood. It's nice. It just had all these renovations done, but I really wish it had, this kind of tub.
Yeah.
Nobody says that. And so we don't make any investments, beyond the model that works for 5,400 properties here in Jacksonville.
There you go. All right. Gary Riley's got a quick question here. Does Jacksonville support the addition of ADUs, accessory dwelling units on rental lots that are large enough to support them?
Some of Jacksonville does and some of Jacksonville doesn't. I'd say the majority of Jacksonville doesn't, but it's a good question. I actually wanted to ask a little bit more about that. So I'm going to make a little note for myself to ask a little bit more, but I know that there are some neighborhoods that do and some that don't.
There you go. We'll hit this next Thursday on the show. GC, good job today, buddy.
Thanks, bud.
Yeah, man, this is a good representation of how you make these questions, like what it feels like to hop on a call with chatwithjwb.com and like see these different scenarios based on what you're looking for. I really got a lot out of it. I'm really pumped for Tuesday's show because it's something that people have been asking for.
They have, and they had to kind of be put on ice for a little bit too. And we had this little storm.
That's right. That was the storm. Yeah, we were going to do it Tuesday, but this is something that y'all have been asking for a long time. It's how liquid are rental properties?
Are you waiting on me? Did you forget?
I had a complete.
I was looking here. I was like, oh, my boy's got this. He's going to land this shit.
Yeah, it's how liquid are rental properties, right? Like how easy is it to sell one of these properties once you invest with JWB? What are the decisions around it that you would make in order to get rid of it or cash out or refinance or whatever you're going to do? I feel like it's been asked a ton. We love to listen to you. If you have any other suggestions for a show, we're gonna go deep into this, right, GC?
Mm-hmm.
I'm pumped for it, man. Good show today.
Thank you. I wanted to put a little invitation out there. We're looking for our next Not Your Average Investor guest for the client journey that we do roughly about once a month. So if any of you are brave and want to join the likes of, oh goodness, Eves was there. Let's see.
Right.
Who else? Jen Filzen's been on the show. Dean Curry was on the show. Leslie Wilson's been on the show. Wow, we've had a lot of folks here. If you want to be brave and sit in the hot seat, Michael Santorios,
Pedro Santorios,
the patron Santorios. Yeah, we would love to do this, and this is where we get to break down your portfolio, and I get to show you between all 5 profit centers how this is actually performing, and you get to get a lot of love and support from the group. So we're looking for our next guest. I think is it the 19th? Madison is the 14th, September 14th. So if you're interested, just go ahead and send Madison a message here and we'll connect and hopefully we can get you on the show.
The community is asking for Erin O'Neill. We got a couple of votes here for Erin O'Neill. We'd love to see her step in through the lights.
Pressure.
We'd love to have you on, Erin, or anybody that wants to do it. It's a fun time, as you all know. I really want to thank, we had a really good attendance today, man. We had like 65, 67 people on here on a Thursday. That's a pretty good number for a Thursday.
I think this is like a message that really connects with people, the cash flow or long-term growth message.
Yeah.
And it's also different than when everybody else hears. So I would love any feedback that you have. If you want to just put a quick little note in the chat, if you enjoyed it, if it was new, if it was different, if you want more of it, because your thoughts and your words really matter. And they form what we're going to do in future shows. So thank you guys.
Join us on the Facebook group if you want to meet all the other folks that are here on this call with you, jwbfacebookgroup.com. Hope to see you Tuesday. Hope you have a great Labor Day.
Yes.
Labor Day weekend.
Go Gators.
And go Gators tonight. And whoever your college football team is, unless you're a fan of Tennessee, Georgia, or Florida State. And until then, there's only one thing that we ask. Don't be average. See you on Tuesday.